Hello again. This video today is going to be about what I see as the biggest issue in putting money into footy cards or investing into footy cards. But yeah, before I get into that, you can probably tell what I think the biggest issue is. But before I get into that, I just want to say if you have any ideas for videos or if you like any specific videos I make, feel free to comment below. I really want to hear what kind of videos people are enjoying and what kind of videos you're not enjoying, just so I can get an idea of what to put out in the future. But today's video is all about liquidity, or mostly about liquidity. There's going to be bits and pieces in there as well about other things. But it's probably good to start with a bit of a definition of liquidity. This isn't going to be the textbook definition or anything. This is just what I see the easiest way to describe it. And I'd say liquidity is how easy you can convert an asset into cash or goods and services. So, for example, I'm going to start with an example straight away. Cash. Well, cash is the most liquid asset and the most safe asset. People might disagree with that or try and argue that, but cash is just unbelievably safe. Like it's backed by the government, so you don't have to worry about, if you've got $500 sitting in the bank, you don't have to worry about tomorrow someone saying, well, I don't think that $500 is worth much. Yeah, I'm not going to take your money. They're always going to take it. Well, they always have historically, so it's a very safe asset. So liquidity is how you can turn this kind of stuff into goods and services. So today's example is going to be about a power bill. I'm not going to write it down, but it's about a power bill. Let's just say it's a $600 power bill. I'm going to explain how certain assets might pay for that power bill and what problems you might have along the way, and to getting into the pros and cons of each asset. So I've already said the big pros of cash, that it's liquid, it's safe. You don't have to worry about it. If you've got a power bill coming up, you can just pay it with cash, not a problem. No one's going to bat an eyelid. Now the problem is inflation. Lots of people think this is a huge problem these days, especially if you read into lots of the cryptocurrency influencers and that say, oh, cash is going to have runaway inflation, like every dollar's going to zero. The Aussie dollar will go to zero, that kind of stuff. I don't think that's a huge risk, but it is real. Like, it does happen. So pretty much every year cash deflates, like the value of it goes down. And generally it's about 1 to 3%. Recently in the US, I think it was like 5% over the past year, which is a lot for a developed country, but usually it's in this 1 to 3% range. So that means, say you've got this $600 power bill. Maybe I will write it up. $600 power bill. And let's just say you've got this power bill and you want to pay it, and you've got $600 in cash. Well, that's not a problem. But then you go, well, I'll probably have this same power bill next year. So what I'm going to do is put $600 in the bank, and then so I have money to pay for it next year. Well, that's not exactly how it works, because the value of money goes down by 1 to 3% a year, or the value of goods and services goes up by roughly 1 to 3% a year. So this $600 power bill, 3%, $18. So it's going to be about $620. So when you put it in your bank and then wait a year to pay for the next one, by the time that comes around, the same bill is about $620. So really you've lost $20. And that is the con about cash. That's why it's, lots of people say, and it's not smart to keep all your money in cash. It's not good to keep, hundreds of thousands of dollars of cash under the bed. But by the same token, you need cash just to live, to pay your bills, to live, to go out to eat, enjoy yourself. So what a big thing in this video is going to be, a big talking point, is there's always pros and cons to every asset. And if people say there's not, well, then they're lying, or they just don't know, because there's always pros and cons. If there wasn't pros and cons, then everyone would just go to one asset. There wouldn't be any need for these other assets to be around. So pros, very liquid, very safe. Negative, inflation, and your general return is minus 1 to 3%. So it's a negative return. Now, this $600 power bill, say, well, I don't want to pay it in cash. I've got some shares. I've got some stock laying around. I want to pay it in stock. Well, let's just say you bought this stock for $400 5 years ago. So you've been holding it for 5 years. You bought it for $450 and now it's worth $600. And you go, well, I'm just going to sell it for that $600 and then pay for the power bill with it. And you can do that. There's not a problem with that because it's also a very liquid market. It's a very highly regulated, very trusted market. You can find the buyer and seller very easily for any reputable stocks, especially stocks on the ASX or anyone in the All Ords. Like, unless you're trading penny stocks, you shouldn't have a problem with finding a buyer or a seller. So you've got this $600. So the pro is that it's liquid. Oh, jeez, liquid. So high liquidity again. Not as much as cash because you still have to sell it. And so this is a positive. It's liquid, and the other positive is historically it's good returns. So I'm just going to put returns. Historically, the stock market has given you about 5 to 8% gross returns. Very generally, in the long run, that's probably the kind of return you're looking at, 5 to 8%. So it's very liquid, and it gives you positive returns, unlike cash, which gives you negative returns. Well, what's the bad thing about stock then? Well, one of the things is that there are transaction costs. So when you buy this, you might have $10 of brokerage to buy it, and then you have $10 to sell it, and then you have to pay tax. So instead of $450, that's really $470, and then you have to pay tax on $130. So you got $130 times, let's just say 30% tax rate, and then you got $40 of tax or whatever. Of course, there's the capital gains rules don't exactly work like that. You get a discount if you hold him over a year, so it might be more like $20 you have to pay in tax. So your $150 gain has turned into $130, and then with tax, $110. Well, that's still a pretty good gain, isn't it? But it's not exactly 5 to 8%. It's $100 over 5 years. So that's, I don't even know, but probably 20% all up. So you're probably looking at more like 4% a year. So with transaction costs, it might be more like 4%. The other thing is it's complex. Even though it's liquid, lots of people find it hard to get into it. You need money to start up. Lots of the time, if you don't have the money to put into it, a decent amount of money, and you're not willing to hold for a long amount of time, then the risk is quite high. Say you only put in $450 and all you wanted was to pay for this $600 power bill in a year's time. Well, if you're only going to hold for a year and you need to sell in that year's time, well, the risk is very high, because the risk, the negative, is timing. If you hold for a long time, then you're never guaranteed anything, but you pretty much guaranteed this 5 to 8% over the long term. But if you're only holding for a year, or even up to like say 5-10 years, then there's a high risk that your money might go down. Like, the stock market doesn't always go up, even though recently it has just gone up and up and up. It will go down at some points, and it will normalize more around this 5 to 8%, whereas it's been more like 10 to 20% probably in the last year. There's just a few. It's a lot harder than just putting cash in the bank and paying your bills with the cash. This takes a bit more capital, takes a bit more knowledge, and it takes long-term thinking. So let's move on to real estate. Real estate is pretty similar to stocks in that you need long-term thinking, and you need high amounts of capital. Even more so, you need a huge amount to just buy a property. So the positive, once again, is returns. Generally, you'll get your 5 to 8% or whatever every year in the long run. The negative is timing and capital. God, this writing is shocking. So the positive is you get good returns, and the negative is that you have to wait for this. If you just buy and then you want to sell within 6 months, there's no point tying up that money, because you've got lots of costs. You've got agent fees, you've got stamp duty, you've got all these tax complications. You've got lots to think about. So although these have good returns over the long term, you need to be willing to hold it for the long term, and you need to be knowledgeable in how things work. Probably didn't go through that perfectly, but we move on to footy cards. And the thing about footy cards, I'm just going to go through the positives first, because it's probably the best to go through positives. I'm just going to clear some space. Okay, I'm going to make this whole section of footy cards. So, the positives of footy cards, it's collectibles in general, but I just like talking about footy cards because that's what the channel is about. So, footy cards. The positives is that it's a growth asset. And that means, well, a card like the Dusty Martin draft pick signature can go from $300 to $1,200 within a year. So that's a 400% return. So that's 400% return in a year versus 5 to 8%. Now this, I'm never going to say you're guaranteed this or you should go in collectibles because you get higher returns. In the long run, you almost definitely get better returns in the stock market or in real estate. But the other plus is that it's easy to access. Easy to access. You don't need much money. You only need a few $100s if you're buying a good card, or you can buy cheaper cards for a lot less and kind of gamble in the market. So you have a chance to win big and you have a chance to lose big. Whereas this, you have upside potential of kind of this or maybe a bit more. But the downside potential is a lot more limited than footy cards. It's not like the stocks have actual value behind them. Footy cards don't necessarily. Like if it came down to it and people need to eat, they're not going to care about footy cards. So yeah, the pluses are growth and it's easy to access. And the third one, which lots of people don't really think about, it's fun. Lots of people enjoy looking at stocks in the screen and seeing their account go up and talking about which stock might be the next one to blow. Well, I see the same thing, but in footy cards. It's tangible, you can see it. It's got history, you can watch the players. It's just really enjoyable to me. And I love having the collection in my house just to look at once in a while and enjoy it. It's like art to me. So it's really fun. And this fun factor is important because you might be willing to lose a bit of return. You might be willing to lose a bit of money just because you enjoy it. And that's how I feel. So the positive is growth. It's easy to access. You don't need to know too much, although it's probably better if you know a bit, but you don't need to know too much. There's no big fees. You don't need a lot of money. It's easy and it's fun. Well, the drawback, the first one connected to the growth, because it can go up a lot very quickly. It can also go down a lot very quickly. So the negative is volatility. It's a very volatile asset, collectibles, and especially footy cards. And the reason why footy cards are so volatile is because they're not liquid. And this is kind of where the whole video was leading. It probably took 15 minutes to get here. It's a bit embarrassing, but liquidity, here it is. So I've got a bit of an example just to explain this and the difference. Well, footy cards, we all know they're very volatile. They can go up and down a lot. But the biggest problem is liquidity. And the reason is, look at this card. This is a 2017 Platinum Stand-Ups Dane Zorko, numbered 368. I actually got this from a pack in 2017. That was about the time I was looking for, the Dangerfields, the Bontempellis, big cards. And I saw this at a servo, the pack at a servo, and I thought I'm just going to pick it up just for a laugh. And I actually landed this card, which was a pretty good hit back in the day. Not big money, but definitely more than the $3 that the pack was worth. So at that point, I think it was worth about $30. And I said, well, I can't really be bothered putting it up on eBay and then paying the eBay fees and then having to ship it correctly and all that kind of stuff. And I didn't even have sleeves or top loaders or anything. So it just wasn't worth it. By the way, if someone wants this card, just comment below, like the video, subscribe, and I'll pick a random person from the comments and you can have this. Just send me the address and it's all yours. Like I said, this card used to be about $30. Nowadays, if you were to ask someone who knew about footy cards, what is this worth on the open market? They'd probably say $10 to $20. I'd say most people would say this is about a $15 card. Well, it's volatile. Like it's gone down half in price. It's gone down 50%, which is a big drop. But the bigger problem is liquidity. And that's because although this is worth $15, what price would I have to put this at for someone to actually buy it? And in my mind, for someone to actually get through, wade through all the eBay listings, all the Facebook group posts, I'd have to put this up for like $5. Granted, not in great condition either. Like, it would honestly be like a $5 card if I wanted to sell it quickly. If I wanted to sit on eBay for a year and just hope someone really wants this card, like a big Zorko collector or a big Lions collector, it could sell for $15. But if I want to actually sell it realistically, I'd have to put it at about $5. And then after fees and shipping, even if I charge for shipping on top of the $5, I'd be getting about $3 back in profit. So volatility brings it down to $15 to $15, but liquidity brings it down another $12 to $3. And that's where the real problem is. And the reason I use a $600 power bill is because I've got 2 cases of Select Prestige 2010. I bought them for $450 for the 2 of them, and I'd say their value is about $600 right now. But on the open market, if I wanted to sell them instantly, I would have to put the price probably about $500. And then after that $500, even if I sold them privately, so I wouldn't have to pay eBay fees, $3 to pay, 3% to PayPal, that's $15 on the 500, and then shipping on top of that, I'd be pretty lucky to break even. So the value is $600, but because it's not a liquid asset like a stock or cash, the money you can actually get out of it is very low. And I've got a couple ideas of how you can limit this, and also how the footy card market might move forward to reduce this problem of liquidity. So the first thing is, I was thinking, I have probably got a pretty bad acronym here, but I call it BBRL. So BBRL. This stands for big player, big card, rookie, and long time. So you get a big player, choose a big player, whoever you want. Dustin Martin, Patrick Dangerfield, Bontempelli, Cripps, even new ones, if you really believe in someone's career, Parrish, Sam Walsh, those kinds of players. You choose a big card. These 2 are really, you can't really argue against them. If you're going for smaller cards, if you're going for smaller players and smaller cards, yeah, the value might go up, but it's really hard to get rid of them. That's extremely illiquid in the market. But big players, big cards, there's always going to be demand for them. And as demand goes up, then the amount of money you lose because of this goes down. So these are non-negotiable. These are just my personal ones. So I prefer rookie cards because I think they have more demand and they have more upside. And this last one, you want to hold it for a long time to decrease your risk. So BBRL, that's just something I think of when I'm thinking about buying a card, whether it fits that and whether, I'd be happy to hold it for a long time. So that's one thing you can do personally to decrease the liquidity risk, or just decrease risk in general. But for the hobby, what's going to change? What's going to help liquidity improve, get better? So the first thing is the market just needs to get bigger. I've said before that the market isn't that small, and it isn't. There's lots of dedicated collectors out there. But the thing is, it has to become more mainstream for people to have belief in footy cards prices, because at the moment people really are scared to buy into big cards because they're really worried about finding a buyer. So once demand increases and the popularity increases, that's really going to help this out as well. The other thing is grading. I think third-party grading is very important in increasing liquidity. You've seen that in the American market specifically. And not just any grading, but grading of important cards and grading of important low value cards, because people need an entry point. People need an entry level. I've said you want to get the big players, the big cards. Well, not everyone can afford the big players, big cards. If you pick Dustin Martin and pick his best card, well, you're going to be spending over $1,000. So what I think needs to happen is smaller cards, but very liquid cards, need to enter the market, and that's your Dustin Martin base rookies. That's your rookie cards from the champion sets. That's your All Australian rookie parallels, that kind of stuff. So yeah, at the end of the day, what to take out of this video, I would say there is risk in everything. There's always pros and cons in every asset class. Now, long term, if you had the money and you had the means, like I said, the stock market and real estate is probably always going to beat collectibles. But if you're willing to gamble a bit, I wouldn't gamble a huge amount of your income or wealth, but you can see big returns, and it has a lot of fun factor. So I just don't agree when people say it's stupid to put your money into collectibles, and I'll continue to do it probably for a long time. But yeah, that's the first thing. And the second thing, I think I said this for every single asset as well, except for cash, obviously, but one of the key things is holding it for a long time. People are very quick to take money out and to take small wins or limit their losses. But at the end of the day, if you have the money, like always, you want to keep enough cash to live. That's number one. If you don't have enough cash to live, then you shouldn't be investing in anything. But yeah, if you do have the money, I'd just keep it in there, because you're always going to win if you just keep it in there in the long term rather than chopping and changing as much. So yeah, if you got this far, thanks for watching. I am in no way an expert in any of this, but I am very interested in it. And I mean, I went to school for business and my job's in that kind of field. So yeah, I don't take anything that I say as, the perfect advice. But if you have any other ideas, chuck in the comments below as well. But yeah, I'll see you next time. I'm looking forward to the next releases coming out as well. Really keen. See you guys.